As I may have mentioned in my last video, my videos moving forward will be a little more a la carte. Instead of one video covering an entire chapter's contents, I'll mostly make videos that cover individual topics within a chapter. Doing so will make better use of your time, as you can just look at the video's title to find the subject matter with which you need help. As for right now, we're going to begin merchandise inventory. I should note that I'll be covering the net method for accounting for merchandise inventory. If your instructor is teaching the gross method, I'd suggest you view my alternative presentation on the subject. Generally speaking, there are three types of businesses. So far, we've talked about the accounting for service companies. These are businesses that sell you their specialized labor or use of their specialized assets. Common examples include businesses like law firms, accounting firms, car rental, auto repair, lawn maintenance, or in the case of our previous example, Coats and Arms, the ever-booming movie prop and weaponry rental industry. The second type of business is manufacturers. These companies purchase inputs, be them raw materials or some other finished product, and then process or assemble those inputs into a new product. Auto manufacturers like BMW or Ford, food producers like General Mills, and cleaning product producers like Procter & Gamble are ideal examples here. This video series covers financial accounting. Manufacturers will be covered in a later course and a much later video, so you can forget about them for now. Lastly, and most pertinent to our next few videos, we have merchandisers. Merchandisers purchase finished products and then resell them. Examples here include auto parts, sporting goods, electronics, and department stores. If you imagine the creation of a commodity like exercise gear or smartphones, it begins with a manufacturer who then sells it to a wholesaler. Wholesalers are companies that buy in bulk and then implement a logistics chain to deliver the products to their customers, commonly retailers. Retailers then sell the product to you, the end consumer. Wholesalers and retailers are the merchandisers because they are buying a finished product and then reselling it. Accounting for a merchandiser will obviously have some distinctions between doing so for a service company. Most notably, income will be calculated differently. Net income is still the difference between total revenues and total expenses, but the calculation for a merchandiser is more sequential. Here you see the steps for calculating net income for these two types of businesses. To put number to these two examples, if we have a service company and a merchandiser, each with $60,000 in net income, the service company just lists all revenues and all expenses and takes the difference. The merchandiser will show its net income as follows. First, we subtract cost of goods sold from revenues to yield gross profit. Cost of goods sold may sometimes be referred to as cost of merchandise sold, but these terms are interchangeable. As for what cost of goods sold actually is, it's how much the merchandise we sold cost us to acquire. This is an expense because we're consuming our merchandise inventory asset by selling it. Gross profit is how much money we have left after deducting the cost of what we sold to cover our remaining expenses. We subtract our remaining expenses, namely those associated with running the business, and we have net income. This is a high-level view of the process. I'll cover the topic in more detail a little later. We're also going to have some new accounts with which to deal. Let's consider a new company, Ride and Fly Bicycles. First, we have merchandise inventory under assets. Merchandise inventory is a resource. We own and control it, and it provides us a benefit. Specifically, we can sell it to make money. We also have a new liability account, customer refunds payable. This one is self-explanatory. When you sell a physical product, you'll inevitably get returns for one reason or another. We'll use customer refunds payable to account for such transactions. On the income side, we'll work with sales of merchandise as our revenue account. Fees earned is what we use to record service revenue, but sales of merchandise is how we record revenue from selling physical products. Sales of merchandise is commonly called sales for short. Finally, our new expenses include cost of goods sold, abbreviated CGS for short. We'll come across some other new expense accounts, but they'll be self-explanatory. These ones discussed here are the big ones of which to be aware. Imagine Ride and Fly purchases $1,500 worth of mountain bikes for cash. Consider what's happening in terms of our accounting equation. We're acquiring merchandise inventory, which is a resource. R&F owns and controls what happens to those bicycles, and that ownership provides Ride and Fly an immediate and/or a future benefit. It can either rent them out, or it can sell them in the near future to earn revenue. Consequently, merchandise inventory is an asset which is increasing. We acquired this inventory by paying cash, so we'll have a decrease in our cash asset. The increase in our merchandise inventory asset will be a debit for $1,500, and the decrease in our cash asset will be a credit for the same amount. What if R&F purchased that inventory on account? It's still acquiring inventory, so we have an increase in our assets, but as a credit purchase, we have an obligation to pay our supplier in the near future, so we've added to our liabilities. The increase in our merchandise inventory is still a debit to the merchandise inventory account, and we increase our liabilities with a credit to accounts payable. When you're dealing with credit purchases, you'll almost certainly encounter early payment discounts. These are discounts off the purchase price offered in exchange for paying sooner rather than later. If you've ever loaned anyone money, you know that the longer that debt is outstanding, the less likely you'll get it back. Encouraging customers to pay early helps prevent that account from becoming delinquent. When you look at the invoice for the purchase, you may see a box titled Credit Terms with something like the text in front of you. You'd read this as 210 net 30. This means that the purchaser gets a 2% discount off the gross purchase price if the payment is remitted within the first 10 days after the invoice date. Otherwise, the full amount is due within 30 days. What if R&F purchases $2,000 of merchandise inventory on account, with credit terms 210 net 30? Note that even if you don't see the phrase on account, the fact that this purchase has credit terms tells us that it's a credit purchase. If the customer paid in cash immediately, then the transaction wouldn't need credit terms at all. Also, oftentimes you'll see the credit terms noted in the journal entry. It's not required, but it's a good idea to do so. That way you have a reminder when you record the payment. So under the net method, our presumption is that we will take advantage of the discount. So we record the transaction at the amount net of the discount percentage. The debit and credit accounts remain the same. We just need to determine the amount for our journal entry. We know the gross amount of the purchase is $2,000. We subtract 2% of the gross amount to arrive at our net amount, or the amount that we owe. 2% of $2,000 is $40. So our purchase net of our discount is $1,960. Another way you could figure out the net amount would be to multiply the gross amount by 100% less the discount amount, or 98%. Either method will get you the correct amount. If R&F pays off that balance within the next 10 days, it'll remove that liability with a debit to accounts payable and credit the cash dispersed as the payment. Let's consider another transaction. Imagine R&F purchases $1,500 of merchandise inventory on account. Credit terms 210 net 30. If you like, pause the video and see if you can figure out the journal entry on your own. As with our previous credit purchase, we still debit merchandise inventory and credit accounts payable. Our amount will be $1,470. You could figure out that amount by taking the $1,500 gross amount and reducing it by 2%, or $30. Again, you could also multiply the $1,500 amount by 98%, or 100% less the 2% discount. Both methods will yield $1,470. What if R&F takes longer than 10 days to pay off that liability? What remains the same? We're still going to debit accounts payable to reduce our liabilities and credit cash for our payment. Now we have to figure out the amounts. Accounts payable and cash should be obvious. Our ledger account shows that we still owe $1,470, so that's all we can remove with our debit. Similarly, we know how much we need to pay in cash. Had we paid within that 10-day window, we'd only pay $1,470. However, since we dallied too long, we have to pay off the entire $1,500. Our journal entry needs a debit of $30 to balance. Where do we put it? The answer? Merchandise inventory. This debit writes up our merchandise inventory to the final amount we paid for it. If I just broke your brain, think back to our cost principle, which said we want to record our asset and liabilities at their costs, since cost is the most objective valuation. Showing the T accounts here may help. As I often tell my students who are stumped by a problem, when in doubt, draw a T account. With our purchase, we recorded the merchandise inventory at $1,470, since that's what we expected to pay. And that is the amount in their T accounts. Perhaps we intended to pay that amount, but we forgot about the deadline. When we did pay, we paid the gross amount of $1,500. Our liability needs to be completely removed since we no longer owe our supplier. The problem now is that our merchandise inventory on the books doesn't match what we paid. Hence, we debit merchandise inventory for $30. When we post that debit to merchandise inventory, the cash asset dispersed matches the value of merchandise inventory acquired, thereby upholding our cost principle. What if R&F only makes a partial payment within the discount period? For example, imagine that R&F Bicycles purchases $1,600 of merchandise inventory on account. Credit terms 210 net 30. We'll record our entry just as we did in the previous examples. debit merchandise inventory, and credit accounts payable. Our amount is the gross $1,600 purchase price reduced by 2%, or $1,568. Imagine that 5 days after that invoice date, R&F pays off $1,000 of the amount owed. Our debit and credit accounts remain the same. We still debit accounts payable and credit cash. What's our amount? It's important to note that most likely the $1,000 payment is the gross, not the net amount. Consequently, we need to do a conversion. Reduce that $1,000 by 2%, and the net amount for our journal entry is $980. Of course, you could also just multiply the $1,000 gross amount by 98%. Subsequently, we're not able to pay off the remaining balance until after that 10-day window. So what do we record? Again, it's always good to list what we know. We know that we'll debit accounts payable and credit cash. That's just what we do when we pay off an account payable. Accounts payable is probably our best starting off point because we can figure out very quickly what we owe. Our initial credit was for $1,568, and we debited it for $980 with our previous entry. So we owe $588. That amount is our debit to accounts payable. We can only remove from the books the liability we put on the books in the first place. Next, we figure out our cash. Remember that this $588 is the net amount, but since we missed that payment window to receive a discount, we have to pay off the gross amount. Remember, one of the ways we figured out the net amount was to multiply the gross amount by 1 less the discount percentage. Consequently, to figure out the gross amount, we just go in reverse. Take that net amount, divide by 98%, and we arrive at the gross amount, $600. Our journal entry just needs a $12 debit to balance. We'll record that amount as our increase to merchandise inventory. At this point, we need to discuss how to handle shipping charges. When you're selling a physical good, it has to be delivered to the customer. Which party pays for the delivery impacts how it is recorded. Our two basic shipping terms are free on board destination and free on board shipping point. With FOB destination, the buyer doesn't legally own the merchandise until it arrives at his or her location. Since the seller still owns the merchandise when it's loaded on the truck, the seller has to pay for the delivery. Once it arrives at the customer's location, the buyer signs for the delivery, taking legal ownership at the same time he or she takes possession. When the selling company pays for the delivery, it records it as an expense. In other words, it'll debit something like delivery expense and credit cash. With FOB shipping point, the buyer legally owns the merchandise inventory as soon as it's loaded on the truck for delivery. Since the seller relinquishes ownership at the shipping point, the buyer has to pay for the truck driver to make the delivery. The buyer will record the shipping charges in the cost of the merchandise inventory, so it'll be a debit to merchandise inventory and ultimately a credit to cash. Remember that this aligns with our cost principle. The buyer is ultimately recording merchandise inventory on the books at the amount it had to pay for it. Just as the discount taken reduced merchandise inventory to the final cost, an additional charge, like shipping and handling, or sales tax, will increase the value at which we record merchandise inventory. A variation of FOB shipping point is prepaid freight. This scenario occurs when the buyer is responsible for paying for delivery, but can't, at least not immediately. Consequently, the seller will pay for the delivery and the buyer will repay the seller for the purchase. The seller's initial journal entry includes the usual debit to accounts receivable and credit to sales revenue, as well as the debit to cost of goods sold and credit to merchandise inventory. As I previously described, the seller covers the initial cost of delivery. In other words, the seller is crediting out cash to the delivery company. The buyer will repay the seller since the buyer is supposed to cover shipping. This means that the seller has the right to receive that reimbursement from the buyer, which it records with a debit to accounts receivable. That's how you record prepaid freight. Credit cash out to the delivery company and debit accounts receivable for the amount now owed to you from the buyer. Conceptually, it's not unlike if a friend were to offer to take you to lunch, but upon finishing your meals, your friend discovers that he forgot his wallet. You'd pick up the check, and your friend would pay you back. As for the buyer's books, the buyer records the normal debit and credit to merchandise inventory and accounts payable, respectively, though the dollar amounts include the shipping reimbursements within them. So how do we incorporate those shipping and handling entries into the journal entries for purchases and payments? All you need to remember is that any early payment discounts need to exclude shipping and handling charges. As an example, if R&F Bicycles purchases $1,200 of merchandise inventory on account with $100 in shipping charges, FOB shipping point, ownership of the merchandise inventory transfers to R&F once it goes on the truck. So R&F must pay for delivery. If you want to break the transaction into two entries, you certainly may. For the purchase, you'll debit merchandise inventory and credit accounts payable for $1,200. Then, debit and credit those exact same accounts for $100. If you just want to book one journal entry, that's fine too. Just debit merchandise inventory and credit accounts payable for $1,300. When we pay it off, just debit accounts payable and credit cash for $1,300, the amount owed. What if that $1,200 purchase price had credit terms of $210 net 30? Book it the exact same way, but only apply the discount to the purchase price. So debit merchandise inventory and credit accounts payable for 98% of $1,200. Next, debit merchandise inventory and credit accounts payable for the $100 freight charge. If you like, you can condense these two journal entries into one. Just be sure when you calculate the amount, you add the $100 freight charge after multiplying the purchase price by 98%. If we pay off the balance within those first 10 days, debit accounts payable for its balance, and credit cash for that amount. What if we pay off the balance after the discount period has passed? We're still going to debit and credit the exact same accounts as in previous similar entries. We're still going to debit accounts payable for the balance we owe. We're also going to still debit merchandise inventory for the value of the missed discount. Just as before, we're writing up our inventory to the amount we actually ended up paying for it. Obviously, you can take the gross price and multiply it by the 2% discount. You can also take the difference between the gross price and the net amount. Finally, we'll credit out cash for the sum of our debits. Remember that if the seller had prepaid the freight, the buyer would book these exact same entries for the purchase and the payment, both before and after the discount period. As the buyer, we're still responsible for paying for the delivery. The fact that we're repaying the seller as opposed to paying UPS or FedEx is irrelevant. We're still paying, so we debit that cost into merchandise inventory. Any early payment discounts are based on the purchase amount alone. What if that $1,200 were purchased on account, FOB destination? Recall that with FOB destination, the seller is paying the shipping charges, so the buyer is not. Consequently, the buyer doesn't need to record anything for shipping and handling. Just debit merchandise inventory and credit accounts payable for the purchase. When the buyer pays off the amount owed, debit accounts payable and credit cash. If there were any early payment discounts attached to this transaction, we would account for them exactly as we did earlier in the lecture. Effectively, when shipping terms are FOB destination, the buyer just ignores the charges entirely. That concludes this video on purchases. My next video will go over sales of merchandise inventory, the opposite side of purchases. Again, please be sure you watch the video covering the appropriate method, gross or net. As usual, thank you for watching. If my videos are helping you and you want to return the favor, you can leave a thumbs up. If you have any questions or suggestions for how I can improve, leave them in the comments below. If you really want to help, temporarily subscribe to my channel, just for however long you're taking your accounting course or courses. Finally, share my videos with your fellow classmates and even your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.